this was our report for Australia Fair this year. That's one of our signature products, as you can tell by the overarching title, Australia Fair. That's exactly what we're aiming to look at. And so this year we looked at the worsening wealth inequality in Australia, and we called it Widening the Gap. So why we were focusing on wealth? Well, like a lot of countries, Australian research has focused on income inequality during the time that wealth inequality has been growing. Now, we've long been warning about the impacts of wealth inequality, particularly as house prices have driven home ownership out of the reach of more and more people, including even those on high incomes. And I know that that's been really coming to a fore in the recent week, and we've been seeing that. At the same time, our social security and retirement systems have stuck with the assumption that most people will eventually accumulate assets and own their own home. So the centrality of home ownership, firstly for stability and security, but increasingly for wealth accumulation to Australia's social security system, coupled with rising living costs, and of course, you know, it is that absolute cliche at the moment, the cost of living crisis. So coupled with that and more insecure work patterns means that work is becoming less important financially than owning a home or inheriting wealth. So it's an important trend that's going to have an impact on wealth, on work, on poverty in Australia over the coming decades. It's not simply an academic issue. It does have impact for policy development in Australia. And, you know, many of the current, I guess, policy measures to address hardship have focused on wage growth and immediate relief. And so much less attention has been paid to the systemic barriers, and that's something that we're hoping to change as we look at this. Now, this is a direct quote here. I'll let you take that in about why the growing wealth inequality matters. But I think it matters even more than we've put here. For me, this is about limited or limiting social mobility, which I think is a very short route to diminishing social cohesion. And I think many of us can point to ways in which that's happening and in which it's undermining our society. It also leads quite quickly to an ability for the cost of living to start to bite to those even with well-paid jobs. That might be an issue for another day, but I know that, again, it's a short route, I think, to diminishing and eroding social cohesion, and one that many of you, I know, are seeing with your clients as we see working people who are homeless, or as we see people coming to emergency relief who have those 1 and 2 incomes. And much like the phenomenon of compound interest, and I'm on dangerous ground here because we have a proper economist later, and I have given Saul permission to kick me under the virtual table if I use proper economic language lazily and in lay terms. But just like the phenomenon of compound interest, if we don't do something about this widening gap and growing wealth inequality soon, it will concentrate even further as our generous tax treatment of wealth transfer between generations allows. So just very quickly, what we mean by wealth and inequality. So income inequality really refers to the income that people get, wages, salaries, other forms of income. I almost think of this lazily like the profit and loss statement, the P&L. And when we talk about wealth, we're talking about assets and liabilities, including properties, investments, basically savings minus debts. Now, wealth builds over time and can boost incomes and generate more wealth through interest, dividends, and appreciation. So this is much more like the balance sheet, which of course is why we need policies to tackle wealth and not just income, because anyone knows that the balance sheet is often the more important indicator of how well a company will do, and in this kind of example, how well a household will do. And I should point out that we didn't tackle company tax. There's lots more to be said there, but this is really, we are looking at household or family or individual wealth. So the first thing we found was that wealth is very unfairly distributed. We used the ABS survey of income and housing and the ABS National Australian Accounts Distribution of Household Income. And you can see from this slide, on the left, we start going through the quintiles. You can see that top quintile actually had about $3.25 million, just short of that. That's 5 times the amount that the middle 20% or the middle quintile had, which has just over $500,000. And over 90 times the lowest 20%, who had just $36,000 in wealth. And then where we take ourselves up into just for a bit of fun, we looked at the highest 10% and the highest 5%, and you can see that, like many things there, or many things, you can see that the tail is much higher. So that average in the 20% is actually being brought down. If we look at the highest 5%, they're sitting there on 6.6 million. So that tells a story of wealth being very unequally distributed in Australia. Now, we wanted to understand where the wealth was held, because what we wanted to do was look at what government policies had done to redistribute wealth, or not to, as the case may have been. And of course, we will go into that finding. But if we look at where the wealth is distributed, and again, this is ABS data, we can see that just shy of 50%, like about 0.2%, so virtually 50% of wealth is held in real estate, be that your own home or other real estate investment property. And superannuation accounts for another nearly 22%. Now, the other bits and pieces you can see in the colours in there, but that means that's really why we want to have a good look at those. And you'll see in the report and the recommendations that that's pretty much where we concentrate. Now, I just want to come to a slide from a previous piece of work we did. It was called The Cost of Privilege. We repeated it more or less in A Costly Choice, which we put out last year. But if we think about the two parts of the housing work there, you can see that the capital gains tax concessions, of the money spent in that, 82% goes to the top quintile, the top 20% of earners. And we end up with 2% down for that bottom quintile. Again, negative gearing sits 55% of the benefits from government goes to that top quintile. And then if we look at super, we can see that 58% of the concessions or the money foregone by government goes to the top 20%, with 0 going to the bottom 20%. So you can see why we're going to concentrate there, very obviously. Now, I did mention that we wanted to look at, over the last 20 years, what had happened to the wealth gap and why. And what we can see when we look at those previous slides, we've got a large inequality in wealth. We've got that increasing over the 20 years that we looked at it. We've got it mainly held in housing and superannuation. And we've got those government policies and concessions really favouring the people who are in that top quintile. So what we're seeing is that government policy is actually driving wealth inequality. And these recommendations that follow are really aimed at rebalancing our conversation, driving towards social cohesion instead of wealth inequality. So basically trying to promote economic security for those who need it most. So we're looking at taxes on housing, retirement concessions that are out of balance. And then if you remember that pie chart, we also touched on investments and shares. So some recommendations there, private trusts and companies. And then, of course, some redistribution to make sure that people on those lowest incomes actually do have some economic security. So if we look first at housing, and I sometimes feel like I'll be quoting housing statistics and things as I'm being carried off in my coffin, because I certainly feel like I can say them in my sleep in a way. But the first set of recommendations we have here are about housing. The first thing we should say is that our recommendations are very much aimed at phasing things out. It's not a market that you would do something very quickly in. So phasing out the regime to make tax housing investments more fair. Like many other countries, we levy a capital gains tax on the profit from selling assets such as real estate. But since 1999, there's been a 50% discount if you've held that capital gain for over a year. And that allows a lot of investors to make quite a bit of money from property sales. It also went together, and Alan Cole has been very big on this, on how the capital gains tax actually fueled greater uptake of negative gearing. And I can see Saul nodding at that as well. So the two together make it a very, very attractive investment proposition where we see the government and tenants assist people to buy extra properties by offsetting losses against those. As we've seen earlier, both of these concessions, the capital gains tax and the negative gearing, really benefited people on those higher incomes way more than people on the lower there. We want to see an incremental phasing out of the capital gains tax and also a targeting of the negative gearing. We know that we need more social housing, so we would like to see it really aimed at that. I'm not going to go into too much detail because, as I say, we want to hear from Saul. We do want to promote, so I'm moving into superannuation, fairness in retirement. One of the concerns I have is that now where we are in superannuation, I can imagine that if we don't do something on superannuation fairly quickly, this will become another sacred cow where people with large superannuation balances want to retain them through to their death, to pass them on as a inheritance rather than actually using it to live on. So we've been quite vocal around the purpose of superannuation, and I think that's something we have to do fairly quickly before that does settle into the Australian culture. The reasons why, if you remember that earlier slide, the concessions in superannuation, greatly favour the highest percentile. 58% of them go to that group, and only 0% to the lowest quintile. Again, there's some fairly technical but very generous concessions, which I'm not going to go through, because I do want to hear from Saul, and because I seem to be inhaling some kind of pollen here. But needless to say, it's also been an area of huge policy change since it was first brought in the 90s, and quite difficult to keep up with. But we can see that middle income earners are worse off than high income earners, and that those who are on low income get nothing whatsoever from these concessions. So again, we're wanting to see that all tax concessions in superannuation are equivalized, I guess, brought into thinking about this. And really, we should be looking at a rebate for those people on the lowest, and really rethinking the proposals that are around the very high and very generous concessions for those on high incomes. One of the issues, of course, with superannuation is that it reflects, it is a workforce attachment model. So those who have earned more throughout their working career, those who have had a higher attachment to the workforce through not taking time off for caring or study, will do better in superannuation. And it's one of the areas we see a very real gender gap. Now, moving into the taxes on investments and shares. It may come as a real surprise, it did to me, that Australia is the only country with a fully refundable dividend imputation system. And I don't know how many people's memories stretch back as far as the 2019, I think it was, federal election, where Labor tried to do something in this. And you had people that had never actually owned any shares, or that this wouldn't actually affect, really getting very uppity about it. It's not well understood, and it does actually allow, there are some loopholes there, which mean that people with these shares and the franking credits, it's kind of a double dip in a way, which really allows the high income earners to use franking credits from dividend payments to offset tax liabilities. So again, it's a fairly technical or dry area. But again, we would like to see those loopholes brought to an end, ending the practice of paying cash refunds for people who've managed to reduce the tax rate to zero and pay no income tax. Now, we're coming towards the end of our recommendations in this report. Looking at private trusts and companies, we can really see that we've got a two-class tax system where some people can use generous deductions and some can't. And basically, the more you've got, the more deductions you can use. That's the, I guess, the accumulative kind of factor in all of these things. Trusts, actually, like all of these policies, these are all legitimate. I should say that we're not implying that any landlords are breaking the law by using these kind of concessions. We're not implying that high income earners are breaking the law in using superannuation, or that these discretionary trusts, while they're pretty opaque when you try and understand them from a policy point of view, we're not necessarily implying that everybody who's using them is trying very hard to hide something. But they, it's the system, it's systemic change that we're trying to bring about in these recommendations. So again, they can be used to evade the tax, they can be used sometimes to move money around. And again, if we think back to that cost of privilege and the costly choice modelling that we did, the benefit or the foregone revenue from discretionary trusts is entirely received by the wealthiest 20% of Australians. So the bottom 4 quintiles receive nothing from this. So again, that would be a clear indicator to a government that wants to look at redistributing wealth, that there's something wrong in here. We come lastly to the economic security for people on the lowest incomes. And again, there's some things to be said here. We want to make sure that those on the lowest incomes are supported and allow them to save and plan for the future. And a lot of these kind of policies don't allow for that. As I've said, the people with the most get to save the most tax. There are things like the waiting period, the liquid assets waiting period. We know that under the current social security law, and we have some recommendations about this in another report we published last week, the spending down to $13,400 before you can access job seeker is very difficult, particularly for example, older job seekers, and particularly when the government statistics now show that the average time on job seeker is 4 years before people get a job. And so particularly if people are in that older cohort, and by that when we think about job seekers, we're thinking people over 50. And a reminder that as the pension age has changed, we're now seeing a growing cohort of people between 65 and 67 on that job seeker payment as well. So these are the kind of things that we want to look at as we also look at the economic security for those in that lowest quintile. These would have costs. They would be so easily offset by all the other recommendations. There would be a drop in the ocean. Now, what I do want to do is to just say that was a very quick overview. There was no expectation that you would have read the reports beforehand or have read them recently, but hopefully in producing these reports in the first place and then in doing webinars like this, what we really want to do is to make sure that you're equipped to use this information for your advocacy, given that you are owners and therefore you own this information. What I really want to do now, though, is to hand over to Saul. As I've said, Saul is a very good friend of Anglicare's around the country and contacted us when we produced this report and said, oh, I've got more to add to this. So I'm really looking forward to hearing that. He's going to speak in greater detail about how the policy settings have contributed to wealth inequality, and particularly intergenerational inequality. And that's something we want to start paying a lot more attention to if Australia is not to become an inheritocracy. So Saul's got an incredible bio. I won't read it all, but even one paragraph is pretty erudite. He's worked as an economist in the Australian financial markets for more than 25 years, including as a Chief Economist for the ANZ Group, Chief Economist for the Bank of America Merrill, Merrill Lynch, and Director of the Productivity Growth Programme at the Grattan Institute. He's currently a Vice-Chancellor's Fellow at the University of Tasmania, and you can see why I was rather nervous about preceding him to talk about some of these findings and matters. So, Saul, over to you.
Well, thank you, Kasy, for the introduction. And I should begin by acknowledging that I'm speaking to you from Lutruwita, Tasmania, of which the traditional owners and custodians are today's Palawa people, and I pay my personal respects to their elders past, present and emerging. I'm going to share my screen, hopefully, that one there. If you can confirm that that's what you're seeing, that would be good. Yes, May? Yep, okay, that's great. So as Kasy said, I read this very good report when it came out a few months ago and contacted May and said, that's a great report, but there is an intergenerational dimension to the widening in wealth inequality, which I don't think gets the attention from policymakers and others that perhaps it should. So I'm going to begin just by overlapping a little bit with some of the things that Kasy said in her presentation. There's no contradiction on my part. I should say, perhaps, Kasy, that one of the few bits of economics that I've been able to get through my two kids is that, as Albert Einstein, who was a scientist rather than an economist, famously said, compound interest is the most powerful force in nature. And it is. Things which compound can grow remarkably big if left unaddressed, which sometimes is a good thing, but often can be a bad thing. So to start with the observation that income, that wealth is typically much more unequally distributed than income. That shouldn't necessarily be a surprise because, as Kasy said in the early part of her presentation, wealth is something you accumulate over a long period of time, as distinct from income, which you earn on a week-by-week, month-by-month, or year-by-year basis. And in Australia, our tax transfer system does a reasonable job by international standards in evening out some of the market forces which do produce a very unequal distribution of income. That is to say, we have, by OECD standards, a reasonably progressive personal income tax system with a top rate that is about the median for advanced economies, but one which cuts in at a relatively low multiple of average earnings. We have a high tax-free threshold. We don't have flat rate payroll taxes on the scale that the US and most Western European countries have to finance their social security systems. And our GST is much lower than those of most countries which have GSTs. In addition, our transfer system is means tested, so we don't tax not relatively well-off people in order to pay pensions to millionaires and others, as the US and most Western European countries do. So although the distribution of income in Australia is by no means equal, it's less unequal than it is in a surprising array of other economies, in particular the ones with similar cultures to Australia, the Anglo-Saxon nations. But by contrast, wealth is very lightly taxed in Australia by comparison with most other advanced economies. And so the distribution of wealth by income or wealth quintile, as you can see here, is much less equal than the distribution of income. And you can also see that from the Gini coefficients that economists are fond of using. As I suspect most of you know, the Gini coefficient is a summary measure of inequality that ranges from 0 if income or wealth were perfectly distributed, that is, everyone had an equal share, to 1 if one person had all of the income or all of the wealth. And again, the Gini coefficients there tell you that disposable income is less unequally distributed than wealth, that the inequality in the distribution of income hasn't really changed much over the last decade, whilst inequality in the distribution of wealth has continued to increase. Just to reinforce the point that I was making before when it comes to the international comparisons, Australia is in the round about the middle of OECD countries when it comes to distribution of wealth. There are different ways of showing that, but here, for example, is the share of household wealth held by the top 10%. Australia, interestingly, ranks below, for example, Sweden in the distribution of household wealth, though we rank ahead of the UK, New Zealand. That is, we're more unequally distributed than the UK, New Zealand, or Denmark and the Netherlands. If we look at the share of household wealth held by the top 1% of countries, then again, Australia is in the middle of the pack. It might be surprising to see that Sweden is where it is, with wealth more unequally distributed, the top 1% holding a higher share than they do in Australia. Whereas countries like Denmark, the UK, interestingly enough, Finland and the Netherlands, wealth is less unequally distributed than it is here in Australia. As I said before, and this is just another way of showing it, inequality in the distribution of wealth has increased over the last 16 or so years for which surveys of wealth have been conducted by the ABS. You'll note that the most recent data is for 2019-20. Normally, these surveys are conducted every 2 years. There should have been one in 2021-22, but that wasn't conducted because of COVID. And so there should be one for 2023-24, which we'll get data on probably sometime in late 2026. But this is the latest data we have. And you can see from this that the share of household wealth owned by the richest 20% of households has risen by 3.8 percentage points since 2003-04, whilst the shares of the 4 lower quintiles have all fallen by between 0.25 percentage point and just over 1.5 percentage point over the same period. So, you know, wealth inequality has continued to increase, but the point I want to highlight here, and will be a recurring theme through the rest of my remarks, is that if you cut wealth not by wealth quintiles, as the statistics normally do, but by age group, there's been a much more striking increase in inequality in the distribution of wealth across generations. This chart shows that the share of household wealth owned by people in households where the reference person, as they now say, we used to say the household head, but where the reference person is 65 or over, that share has risen by almost 11 percentage points between 2003-04 and 2019-20. That's a big increase in a relatively short period of time. The share owned by households where the reference person is 54 to 64 has risen by just under 3 percentage points, whilst the shares owned by people aged under 55, or in households where the reference person is under age 55, has fallen quite significantly over the same period of time. Now, part of the reason for that, of course, is the aging of the population. You know, the people living in households where the reference person is 65 or over now represent, or at least in 2019-20, represented a bit over a quarter of the population, compared with a bit under 1/5 in 2003-04. So that's an increase, if you like, of 5.6 percentage points. But as you can see, their share of household wealth has risen by 10.8 percentage points over the same period. So more than half of the increase in the share of household wealth owned by people aged 65 plus can't be explained by the aging of the population. Rather, it reflects the fact that older households disproportionately own the assets which have gone up most in value over this period. And that's something that Kasy alluded to in her presentation, but I'll show you a bit more data that illustrates this point. This shows, for the 2019-20 survey, the proportion of financial assets owned by households in each age group. And I've divided that up into superannuation and other financial assets such as shares, bonds, cash, and bank deposits. And, perhaps not surprisingly, you can see that the share of financial assets, and in particular superannuation, rises fairly steeply as the population ages. This chart shows the ownership of non-financial assets by age group. And here I've broken it up into owner-occupied property, that's your own home, other property, it's investment properties and commercial property, and other assets, which is mostly things like motor vehicles, plant and equipment that's owned by privately owned businesses, and furniture and other things that people have in their dwellings. Now, here what's striking is the significant increase in, as people age, in the ownership of owner-occupied property. There's quite a steep increase between households under 35 and households under 55 in the ownership of investment properties, but it levels out after then. And the same is true of the ownership of other assets. Whereas by contrast, debt is disproportionately concentrated in younger households. By the time people reach 65, they've for the most part paid off the mortgages on their own home, although, as I'll show you, the extent to which that will be true over the next 50 years will decline as more people reach retirement age without having paid off their mortgage. But for now, most retired people have paid off their mortgage. They might still have some outstanding debt on their investment properties, but they've paid off their mortgages. Whereas, of course, people in younger age groups, if they own a home, have had to take out much bigger mortgages in order to purchase them. And increasingly these days, of course, younger people also enter the workforce with a significant amount of student debt. There's not much student debt hanging around on people in their 50s or 60s. If they're like me, they were lucky enough to have got their tertiary education for free in that period between 1975 and 1988, when there were no fees for tertiary education. And this chart shows that those assets which are disproportionately owned by older people have increased as a share of household wealth. So focusing in particular on land, which more than bricks and mortar themselves has been the major factor behind the increase in property prices over the last 30 years. That's the blue line there, blue area there. And superannuation and life insurance, that's mostly superannuation, is the red line there. They have increased as a share of personal wealth, whereas most other assets that go to make up household wealth have declined as a share of personal wealth. Just again, to put an international dimension on that, these are slightly different figures from the ones that Kasy showed for Australia, but they're sourced from the national accounts rather than from the Survey of Income and Wealth. And they show that a much higher proportion of Australian personal wealth than of personal wealth in the 4 other countries that are culturally most similar to Australia, with the exception slightly of the UK, are held in real estate and superannuation assets. In the United States and Canada, for example, a much higher proportion of personal wealth is held in business assets. That's other, the last area shown there. In New Zealand, where they don't have compulsory superannuation, a higher proportion of personal wealth is held in shares, as is also the case in the United States. But the proportion of wealth held in real estate in Australia is higher than in any of these other 4 directly comparable countries. And the share held in pension funds is about on par with that in the UK, where although superannuation isn't compulsory, the culture in the UK has been certainly to favour that. So in particular, the concentration of real estate ownership among older generations is a key factor behind the increase in inequality in the distribution of wealth across generations. And that is almost certainly going to deteriorate quite significantly in the absence of policy change over the next 30 years. This chart here shows Australia's home ownership rate back to the first census in 1911. And there are really kind of two important episodes in Australia's history of home ownership. The first is between 1947 and 1966, when the home ownership rate increased from about 50%, 51%, to a peak of 72% in 1966. And that was essentially in the face of a percentage-wise faster increase in population, especially in Australia's capital cities, than has occurred ever since, because of the combination of the post-war baby boom and the huge migration intake that we pursued in the 3 or so decades after World War II. But also because government policy in that era really focused on boosting the supply of housing, both by governments building or financing the construction of a lot of housing themselves, and secondly, by governments at the state and local level seeing it as part of their job to facilitate the construction of new housing by the private sector. But what governments didn't do in those days is artificially inflate the demand for housing. I don't think it's a coincidence that Australia's home ownership rate peaked in 1966 and has been declining ever since, because the 1966 census was the first one after the beginning of a momentous change in Australian housing policy, which was the introduction of the first homeowners grant scheme in 1964, which Robert Menzies promised at the 1963 election at the urging of the New South Wales Young Liberals, whose president in 1963 was a young fellow called John Howard. And that marked a turning point in housing policy, which over the following 60 years has seen the emphasis of housing policy shift away from boosting supply towards inflating demand, and at the state and local level, and especially in New South Wales, artificially constraining supply through planning and zoning laws and increasingly onerous taxes on the construction of new housing. What that overall home ownership rate disguises, however, is the dramatic declines in home ownership rates among people aged 45 or less. The home ownership rate among people aged between 25 and 34 at the 2021 census was now back to where it had been in 1947. The home ownership rate among people aged 35 to 44 in 2021 was back to where it had been at the census of 1954. Even among people aged 45 to 54, the home ownership rate at the 2021 census was back to lower than it had been at the census of 1961. Some of that, of course, reflects changing attitudes and social patterns among younger people. Younger people don't get married and start having children in their late teens, as was very common in the immediate post-war periods. Younger people spend more time in the education system, and they emerge from that nowadays with significant amounts of student debt. Younger people have other interests, including travel, that wasn't an option for people who became adults in the late 40s, early 50s and early 60s. So there are social changes that explain part of these dramatic declines in home ownership rates. But overwhelmingly, in my view, it's been the deterioration in housing affordability that explains this dramatic decline in home ownership rates among younger adults that is at the heart of Australia's housing crisis, and it's called, and it often surprises me that there isn't more anger among younger generations at the way in which the housing system has effectively been rigged by their parents and grandparents since, in particular, the early 1990s to their detriment. But there you are. Another dimension of this, which comes from figures compiled by the Commonwealth Bank based on their analysis of transactions by their 7 million or so customers, is that in what the media now call the cost of living crisis that Australians have been confronting over the last 2 to 2.5 years, there's a striking disparity in who is bearing the greatest burden of cost of living increases and the battle against inflation if you cut it by age groups. And it's people aged under 30 who are, that should say 30 to 39, not 30 to 29. It's people under the ages of 40 who have had to reduce their spending on both essential and discretionary items, because they're the ones who've seen their real wages go backwards. They're the ones who are most likely to either be renting or to have taken out big mortgages in order to get out of renting and become homeowners, and have therefore borne the burden of the steep increases in mortgage rates. Whilst people aged 60 and over, who in some cases benefit from higher interest rates because they have term deposits, and who typically don't have mortgages, and whose pensions, if they're on the pension, are fully indexed for movements in the CPI, they have been able to carry on growing their spending on both essential items and discretionary items as if nothing had happened. You know, so there is an intergenerational dimension to the cost of living crisis as well. Kasy alluded to this in the second part of her presentation, and I'm going to show you some charts that support what she said. That said that shows that part of the increase in inequality across generations in Australia is the result of deliberate changes to our tax system that have been made over the last 20 or 25 years. This chart on the left shows that the average tax rate paid by people aged 65 and over is significantly lower than the average tax rate paid by other Australians. Now, some of that's because most of our taxes are levied on income. You know, income tax is the biggest source of revenue for Australian governments. And many people over the age of 65 have lower incomes because they've retired, they're on the pension, or they're drawing down their superannuation. They, as I showed earlier, have considerably more wealth, and hence you might argue capacity to pay tax, but they're not asked to pay tax. And that's in part because, particularly in the last two terms of the Howard government, there was a succession of measures introduced, such as increased concessions for money taken out of superannuation funds, which were effectively exempted from tax, increased concessions for one-off contributions to superannuation funds, which in 1 year you could contribute up to $1 million to your superannuation fund without paying any tax on it. Things like the Senior Australia's tax offset, as well as the introduction of the much more generous capital gains tax discount in 1999 that disproportionately benefited older Australians. The chart on the right shows that there's been a significant increase in the number of households headed by people aged 65 and over. As I've shown you before, they have accrued an increasing share of both income and wealth, but there's been almost no perceptible increase in the share of income tax which they pay, despite their obviously increased capacity to pay more tax. An important dimension of this is the way Australia's income tax system treats different types of income. Most people in Australia, and in particular about 85% of those who are not in the top tax bracket, that is, whose taxable income is less than $180,000 a year, earn their income in the form of wages and salaries, which is taxed. If you earn more than $180,000 at 46 cents in the dollar, it's taxed at the marginal rate. But most other forms of income, with the exception of interest, that's also taxed at full marginal rates, is concessionally taxed by comparison with the way that wages and salaries are taxed. And what's interesting is that taxpayers whose taxable income puts them in the top tax bracket, only about 52% of their income is in the form of wage and salaries, which is taxed at the full marginal rate. Capital gains, income from partnerships and trusts, dividends, and thanks to negative gearing, gross rent, are taxed typically at less than the full marginal rate. And these forms of income accrue disproportionately to older Australians. One source of income and wealth that isn't taxed at all in Australia is inheritances. Since the abolition of estate duties in Australia between the late 1970s and the early 1980s. Now, some people think that as the baby boom generation who have benefited most from the extraordinary increase in property prices over the last 30 years and from the rapid growth in and generous taxation treatment of superannuation, since it became compulsory in the early 1990s, that as they die off, some of these intergenerational issues will fade away. That's actually not true, because most of the inheritances that will be bequeathed by the baby boom generation will accrue to people who are in their 50s or older at the time, not to people who are in their 20s or 30s. This chart shows work that was done by the Grattan Institute in 2019 based on scrutiny of probates granted by the Supreme Court of Victoria in 2016, which shows that 82% of inheritances in 2016 go to people aged 55 or aged 50 or over. And the majority of them go to people in the highest net wealth quintiles. In other words, the inheritances that are going to pass from the baby boom generation to their successors over the next 30 to 40 years will, in the absence of any policy change, increase inequality in the distribution of wealth, both across generations and across wealth quintiles. Australia is one of a minority, it's a large minority, but a minority of countries that have no form of tax on inheritances, bequests, estates, or gifts. In particular, the US and the UK, whose tax systems are most commonly used as points of comparison for Australia's because of the cultural similarities between our three countries. The US and the UK both still have inheritance taxes. And interestingly, neither, as their acolytes would put it, St. Ronald Reagan or St. Margaret Thatcher, thought fit to abolish them when they had the capacity to do so during their 8 and 12 years in office. They are regarded as an appropriate part of the taxation system of those countries. I should say, and it might surprise some of you, that countries like Sweden and Austria don't have their estate duties. The reason they don't is because they tax wealth on an annual basis while you're alive, and therefore don't perceive a need to do it when you're dead. Whereas most of the countries where estate taxes or their equivalents account for a bigger proportion of revenue don't tax wealth. France is one of the few countries that taxes your wealth when you're alive as well as when you die, but they're an exception. If Australia were to reintroduce inheritance taxes, and there's no reason why the federal government could, even if states were apprehensive that if they did, rich old folks would move to some other state that didn't, which is, of course, what started it when Joe Bjelke-Petersen abolished death duties in Queensland. But if the federal government did it, then there would be nothing to fear from that front. And it surprises me that no one's really talking about that. So I'm going to finish with 2 slides that address the question, what could be done to slow the rate at which inequality in the distribution of wealth, especially across generations, is increasing, or indeed, if you wanted to reverse it. And here's a list of things, most of which wouldn't, I hope, come as no surprise to you. Given the importance that declining home ownership among young generations has played in increasing intergenerational inequality in the distribution of wealth, I would say at the top of my list, stop doing things that make housing less affordable. That is, stop first home owner grants, stamp duty concessions, mortgage deposit guarantees schemes, untargeted shared equity schemes, tax breaks for property investors, and don't even think about super for housing, as the coalition is advocating, because we've got 60 years of history going back to that first home owners grant introduced 60 years ago. That anything that allows Australians to spend more on housing than they'd be able to otherwise results in more expensive housing, not in a higher proportion of people owning that housing. So stop doing dumb things and start doing or do more of things that would make housing more affordable, such as reforming planning and zoning laws and regulations, reducing taxes and charges on new builds, and addressing the factors that prevent the construction of affordable apartments for families. It's becoming increasingly obvious, and people are starting to pick up, that builders and developers can make money building blocks of apartments of bed sits for students, and then make money building penthouse suites for millionaires. But it's become very difficult to build apartments with, say, 3 bedrooms for families at around $600,000 and still be commercially viable. There are things that need to be thought about to reform that. Second, reduce the concessionality of the tax treatment of superannuation. There is an argument for taxing superannuation savings more lightly when they're compulsory, because you are forcing people to forego income that they might otherwise be able to spend. But it doesn't have to be as generous as it currently is. You could, for example, replace the 15% flat tax on contributions and superannuation earnings with a 15 percentage point rebate from the tax that you would otherwise apply, so that you retain a degree of progressivity in the tax treatment of superannuation savings and earnings. You could reduce the tax-free threshold for payments out of superannuation funds to people in the retirement phase of that. You could reduce the concessionality of the tax treatment of income from investments relative to wage and salary income, for example, by reverting to the pre-1999 model of taxing capital gains at the full marginal rate less an allowance for CPI inflation, or at the very least, reduce the capital gains tax discount from the excessively generous 50% to 33% as the Henry Review proposed, or 25% as Labor did in 2016 and 2019. You could, and I think should, restrict negative gearing to investment in newly built rental properties rather than allowing it for people who buy established properties. You could look through trusts for tax purposes, as Kasy, I'd say, as in a different way from what Kasy did. But I've got no problem with people using trusts to shelter their assets from vengeful ex-spouses, indigent children, and others. But there's no reason why they should be used to reduce tax by fictitious income splitting, as trusts, to a much greater extent than in any other developed country in the world, allow people to do. I'd argue that replacing stamp duties on land transfers with a broadly based land tax that doesn't exempt owner-occupied properties would do something to reduce intergenerational inequity in the distribution of wealth, because stamp duties are disproportionately paid by younger Australians purchasing either their first property or sizing up to a bigger property as they start to form families, whereas, as the data I've shown you demonstrates, the exemption of owner-occupied housing from land tax disproportionately benefits older Australians. And I'd say that if states aren't prepared to do that, then the federal government could do it by reintroducing a land tax. Most people have forgotten this, that there was a federal land tax between 1910 and 1954. They could reintroduce that and give the revenue to the states and territories on the condition that they abolish their stamp duties, which they have the constitutional power to do. And finally, as I've argued, the federal government at least should contemplate reintroducing inheritance taxes as part of any comprehensive effort at tax reform. But if it did so, it would need to ensure that the thresholds are indexed so that inflation doesn't drag relatively smaller states into the tax net, as it did as a result of the huge inflation Australia experienced in the early 1950s, and then the progressive inflation Australia experienced from the mid-1960s to the mid-1970s. It was the abject failure to index the thresholds for estate duties that made it the object of the political campaigns against it that ended up being so successful. The final slide I'll show you is that Andrew Leigh, who was a professor of economics at ANU before he went into Parliament in 2010, and who amazingly continues to turn out books every couple of years, has what I think are also some very good ideas for containing and reversing the trends in inequality. Most of these are, to me as an economist, common sense, but they include maintaining strong economic growth underpinned by improved productivity, which requires a commitment to open markets, unlike what we're going to get from the Trump administration in the United States. It requires policies that encourage innovation, including good public infrastructure, appropriate regulation, and incentives for research and development. Second, we need to improve our education system, which increasingly is letting down students who come from the most disadvantaged households. We need incentives for the best teachers to work in the most disadvantaged schools, better programs to deal with increasing disengagement on the part of young people from disadvantaged backgrounds, and high quality early childhood programs for children from disadvantaged backgrounds. Andrew says, and I agree, we need to acknowledge the role that family structure plays in perpetuating advantage and disadvantage across generations. That doesn't mean passing judgment on the circumstances of people for whom life has dealt unfortunate outcomes. But it does, he argues, and I agree, encourage you to build up the evidence on light touch programs that encourage relationship stability rather than making family breakdown the first option. He advocates recognising the role that unions can play in reducing inequality, which doesn't mean a return to closed shops, but does allow unions to have a role in negotiating wages and conditions. He argues that welfare programs should continue to be targeted towards those most in need. And, we've retreated from that a little bit in the way that, for example, energy bill relief has been distributed on a completely unmeans tested basis in Australia over the last year or so. I got two, because I've got 2 meters on my property, I got 2 bouts of electricity bill relief this year. I don't need one of them, let alone 2. That money could have been better targeted. Maintaining a progressive income tax system, which, as I mentioned before, Australia has done pretty well at by comparison with culturally similar countries, at least in regard to income, if not into wealth. Andrew has always been an advocate of using randomised trials, similar to those that are used and have been for a long time to evaluate proposed new drugs and proposed new medical treatments to evaluate social policies as well. And he gives a number of examples in this book of where that's been done in other countries. He advocates keeping a check on monopoly power through strong competition laws, which almost every economist would support. And he advocates recognising the link between inequality and social isolation that plays into a number of other, particularly mental health problems. So there are a lot of things that could be done if governments were serious about arresting the trends in inequality in the distribution of wealth, especially across the generations that I've been talking about, and things that could be done to reverse that if governments were sufficiently motivated to do so. Of course, the fact that older Australians are an increasing proportion of the electorate, and in particular the fact that whilst there are typically only 100,000 people who succeed in becoming first homeowners each year, and even if you assume for every one that succeeds there are 5 or 6 who don't, that's only about 600,000 or 700,000 votes for policies that would restrain the rate of house price inflation, as against there being 11 million households who own their own home, another 2 to 3 million who own an investment property. That's anywhere between 11 and 14 million votes for policies that would keep house price inflation going, as it has been for the last 30 or more years. As I sometimes say, even the dumbest of our politicians can do that math, and they do every day. That's something that has to be challenged if any progress is ever going to be made on this front. And all of you in Anglicare and similar groups are in a better position, I think, to advocate for that than I am. So I'm going to stop there, Kasy and May, and if there are any questions, be happy to do my best to answer them.
Thank you so much, Saul. I think we have actually run out of time for questions, unfortunately, but we are very grateful to you for giving us your time, being so generous with your time, and being so generous with all of that material you've just shared. For those who are interested in having a read of it afterwards, we will send around a copy of Saul's slides and also Kasy's slides. And we'll also put up a link to the recording from today's webinar. As it happens, Kasy also has to rush off to an event with Andrew Lee, as it happens.
I think that's my that's my phone going. Thanks, Saul. Thanks, everyone.
Yes, I thought that was a coincidence as you pulled up his name in his book. But we do want to thank you so much for joining us today, and to thank everyone who was able to come today. This is the beginning of a bit of a work program for us on wealth inequality. And one of the reasons we were so keen to have Saul join us is because we are looking at doing a piece early next year on intergenerational wealth inequality, which we know can be a bit of a controversial area. And we thought this would be a good way to kind of start that conversation and I guess show you all where we're coming from. So there'll be more opportunities for us all to talk and go over some of those ideas in the future. So thank you everyone for joining us, and thank you, Saul.
Pleasure. Bye.
Thank you.